Hello, I'm Dominic Hobson, co-founder of Future of Finance. My guests today are Tilman Fechter, a member of the Executive Board and Head of Banking, Funding and Financing at Clearstream Banking, and also a member of the board of HQLAX, and Nick Short, Chief Operating Officer at HQLAX. Our subject is what HQLAX is doing to move the securities industry towards what the company is calling frictionless ownership transfers of assets, starting with improved collateral mobility between tri-party agents, of which Clearstream is one, and fellow shareholders BNY Mellon, BNP Paribas Securities Services, Citi, and JP Morgan are others. Tilman, Nick, thanks very much for joining us.
Thanks, Dominic.
Thank you.
Now, the clue is, of course, in the name. Is your mission here basically to run a securities lending swapping service to help investment banks meet regulatory demands, set obviously by the capital ratio, the net stable funding ratio, the leverage? There's so many of these things that demand high quality liquid assets. Is that your basic mission, to meet those demands, to post HQLA as collateral through collateral upgrade trades? Nick.
Yes, thank you for the question. And yes, that's certainly the original aim of the platform. And we are using distributed ledger technology to enable clients to swap baskets of securities simultaneously across different collateral pools. And in fact, today we have Clearstream, Euroclear, JP Morgan tri-party services connected to the platform. And in addition to that, by the end of this year, we'll also have Bank of New York, BNP Paribas Securities Services, and Citi Custodian connected to the platform as well. We are focused on Europe to begin with, and we feel that those names give us a good head start in terms of the collateral pools within Europe. With Deutsche Börse, we have built an operating model that enables our clients to exchange ownership of baskets of securities across these locations, and importantly, able to do that at precise moments in time. In other words, whenever they want. And that's really one of the new value adds that, that our platform provides. This allows our clients to reduce their capital costs by either reducing intraday credit exposures or avoiding intraday liquidity requirements, which are the result of how these trades are done today prior to the HQLAX platform being available. This is the initial version of the product that we have live, but it's also worth stating that we have several variations to this original model in the development pipeline, including holding securities at custodians, i.e. not tri-party, allowing ownership of securities to be exchanged for cash, as well as allowing these securities to be pledged for margin purposes.
Mm-hmm. Thanks, Nick. Now, Tilman, Nick did say that you're using blockchain technology to underpin the platform. Am I right to understand, and this may be a false memory on my part, dating back to a discussion with Clearstream probably many years ago now, about a tokenized collateral platform that you were then experimenting with. Am I right to understand that HQLAX is operating without the collateral having to move because it's tokenizing it onto the blockchain, leaving the assets themselves actually in custody? You can then put these tokenized assets into these baskets, and you can put them onto this ledger where everybody can see who owes what and who owns what and who owes what. Is that right? And if not, how does the HQLAX work in practice, and how does it satisfy the regulatory demands which we've just talked about?
That's an interesting question, and the answer is yes and no. So the assets itself are not tokenized, right? So the assets itself are staying at the TPA or the custodian. It's just the right into the assets, which the TTP, and we have put this in between the trading layer, the DLT layer, and the custody TPA layer. There's a trusted third party, and the trusted third party, its sole role is to make sure that in the account of, let's say, the TPA, it's moved from one account to the other into the name of the TTP. Then the TTP is the owner of the legal owner of the assets, and we are tokenizing the assets into a basket. And this token then will be put onto the blockchain where it then can move, right? So it's basically the TTPs bridging the old legacy and bringing the old legacy, call it interoperable, to the new DLT network. So the asset itself stay with the custodian or the TPA, the tri-party agent, but the rights into these assets are tokenized. And this token then is put on the blockchain and gives all of the advantages we'll probably talk about later. And the regulatory compliance aspect obviously is very important. And it's the TTP, which is a Luxembourg-based entity, which is highly regulated, and it's regulated by the CSSF, which adds this comfort to all of the financial institutions, obviously, because building the system for HQLX and the TTP surely costs a couple of millions, but the real effort and all of the brain power was really on the legal construct, from trading, blockchain, the trusted third party, and the TPA, to ensure that the legal owner at all moments are very clear. And that vertical silo, with all of the legal checks from a TTP, TPA, customer level, and then jurisdiction by jurisdiction, was most of the work to be done in this project. And that's why it took a bit longer, because there's regulatory compliance and give a customer the comfort that their assets are at all moments in time correct and transparent, and everyone knows this rule book, who owns what at what moment in time, and even as far as what happens if the one side doesn't deliver their obligations, or even at a moment of a default of a customer, what happens.
Now, Tilman, you mentioned this cost several millions, but it probably cost a lot less than trying to completely reinvent the entire collateral management system of the world. It may be too soon to say this, but do you view the way that HQLAX is structured today, with the assets staying in custody and them being moved through the platform in tokenized form, is this a transitional stage? And do you eventually envisage that the entire market will move towards a tokenized model?
That's also a good idea and a good question. We believe that at the moment, HQLX is the translator between the old and the new world. It's going to stay in this hybrid environment for quite some time, because we're not going to have even if in Europe we would decide, there are so many parts of the world which still have a legacy system in place, which want to jump to the new technology. And maybe at a later stage, we'll have a HQLX and others coming up. And there's an interoperability on the DLT blockchain level as well. I think the real big advantage comes in many years to come if the assets itself are digital. Right? Then we come into a new game where maybe this translation, old and new world, is not needed. But we are certain that this hybrid world and this translation is there for a couple of decades, probably.
Mm-hmm. Now, Nick, you brought up the question of the technology. In some of the blockchain-based projects that we've seen, such as that famously launched by the ASX in Australia, but also the CLS blockchain network as well, they're not actually operating in a way which users are operating their own nodes. In other words, they, as the provider, are continuing to operate those nodes on behalf of the users. Is your model the same as that?
Yeah, that's a great question. And I think, just following on from the points that Tilman just made, I mean, we have consciously taken a view that because this is new technology, that we are going to take what we call baby steps towards the end vision. And that's certainly true with the DLT, the distributed ledger technology nodes. We're using R3's Corda DLT solution. And it is true that in the current version of the platform, HQLX does host all of the client nodes as a first step to making it as easy as possible for clients to adopt this new solution. However, what I would say is that we, at the same time, are also working with several clients, not all, but several clients who are very focused on running the nodes themselves, and we will help and support them in reaching that objective.
Mm-hmm. Tilman, I've been in this business long enough to know that collateral mobility has been a running sore for probably for 30 years now. People have got all these assets lying around in CSDs and sub-custodian banks all over the planet, and various attempts have been made over the years to make this process more efficient. But in particular, back in 2013, a couple of your shareholders, in fact, BNP Paribas and Citi, reached these arrangements with yourselves at Clearstream and with your friends across the Ardennes at Euroclear to enable owners of these assets to mobilize them to secure positions or borrow the stock, or whatever. What's the improvement that offers on that sub-custodian into the local CSD arrangements, which were cooked up back in 2013? How does this improve on that?
Yeah, I think that's still ongoing, right? Not just because and between the TPAs and us and Euroclear to get interoperability for the good of the customer in the market between the TPAs and the various CSDs and ICSD. And I think it had been worked on more the last couple of years to really get the pipes open in between these so far very siloed organizations. That's a good development. On the other side, it is still physical movement of assets. So if something is transferred from the one TPA to the other or from one custodian to the other, is physical transfer of the assets. And I think the advantage of HQLX next to the instantaneous atomic settlement and all of that is that it doesn't need that anymore. It brings it onto a different level, and the assets are just staying in the custodian the customer is preferring, which has at the end game a very big advantage because you could keep your long box at just one TPA or custodian, and out of that we are just taking it out and putting it on the blockchain, but you don't need to move it around across various jurisdictions, settlement systems, etc. It's not a physical move anymore. It's just the right which we are tokenizing and which will exchanges ownership afterwards. So there's a big difference in the old interoperability, which had been worked on, and it's still existing, and it's good, and it's needed for other use cases, which because HQLX just covers a specific segment, there's still a lot of use cases where you need interoperability between the players, and it's also improving. Yes.
Just staying with this point a minute, someone, should I be surprised that you didn't mention CSD, central securities depositories? You talk about tri-party agents and custodians. Should I be surprised that CSDs were not part of your target audience, as it were?
Then we need to be maybe a bit clearer, because the ICSD, so Euroclear and Clearstream, are part of HQLX. We also got the other custodians, like a Citi who's invested and joins as in the capacity of custodian, and many more to come. But normally we are driven by the market demand, and we have connected, let's say, the who is who of the TPAs. So the JP Morgan, BNY, Euroclear, Clearstream, and also in the capacity of ICSD, we are adding Citi, who also invested, and there are a few more which are in the pipeline, which are in discussions to be connected as well. So we haven't overlooked it. We have got the two biggest ones, the ICSDs, but we are open. So if a CSD really wants to open up with their collateral offering, we would be open to that, yes.
Just so I'm clear, I assume that the CSDs, which both you and Euroclear own, are part of the network. What I was really thinking about was the independent CSDs of Europe, or even the Swiss-Spanish CSD alliance, for example. Are they? The system is open to them.
Yes.
Am I right?
Yes.
So anyone,
yes.
anyone can.
Yeah. Of course, we were, as I said at the beginning, it's market demand. So we started off HQLX started off with Deutsche Börse right at the beginning with a couple of 10 banks around the table. And these 10 banks had TPAs or custodians, which they brought to the table. So it's a bit of push and pull. But they pulled us the TPAs they wanted on the platform. And if new customers, new regions coming in the future, and let's say it's a Swiss player who holds the collateral, not the domestic collateral, but maybe international collateral in SIS, for example, we would be open to SIS to open an account equally in the TTP and HQLX, obviously.
Right. Now, Nick, you're called HQLA. The clue, as I said at the outset, is in the name. Is this model capable of extension to other asset classes as well, including, say, cryptocurrencies?
Well, that's a good question. I mean, in theory, the answer is yes, but there are some practical challenges that come with that, and Tilman has already alluded to some of the legal overhead involved in getting the platform up and running. So from a technical perspective, I think it's probably easier. From a legal perspective, it's probably more challenging. But it's true that our vision is to accelerate the financial ecosystem's transition towards frictionless ownership transfers of assets, and we are focused on financial institutions that are highly regulated and are securities interested in securities lending or collateral management, and so we're primarily focused on the assets typically used in those marketplaces today. So that's really HQLA, corporate bonds, equities. That's our initial focus.
Mm-hmm. You don't have a timetable for extending to other assets. You want to make this work first before you think about other things?
I think yes is the short answer to that. Yeah.
Now, Tilman, Nick mentioned in his opening remarks the business case for this, the liquidity savings, the capital savings, for example, because you're not handing over cash, you're not consuming credit. There'll be operational savings as well. And I was interested reading your own brochure that you put excess HQLA held by the tier one banks alone at 3.65 trillion euros, which leads to excess costs as well of 10% of that number. So we're talking quite large savings here, actually. But how exactly are the users of the system going to capture those savings, and over what sort of time scale?
Maybe I give Nick the chance to answer, and I will just add maybe how we see it from a market perspective. But HQLX did the study and came up with a number, so I'll let Nick answer.
Yeah, I mean it's a great question, and the materials obviously talk about this in aggregate form across tier one banks, and is intentionally generic. The reality is that each institution calculates the cost benefit analysis themselves internally, and each one has a different way of doing it. But what I would say is, one thing that we've observed is that some institutions calculate this more granularly than others. So what that really means is that some institutions already factor in the capital costs of doing an individual transaction, so that it's clear in advance before the trade is executed. Other institutions have more end of day or less frequent reporting. So each institution is different, but one trend that I think I've observed is that increasingly these costs are becoming more apparent to the people that are generally pressing the button and executing trades. So that's certainly a trend that we've seen.
Maybe to add, we also see that people there's a scarcity of collateral. So even if you've got enough collateral around, it might be in the wrong jurisdiction, wrong settlement system, wrong time zone, batch processing. So you have enough, but you can't leverage it. Then you need to finance your trade and your collateral again in a different country, although you would have it in a different one, right? So, and that's getting very expensive. So I would say next to the ops and efficiency and risk reduction, it's also on trade by trade overall, there's a saving. If you have got enough collateral, if you have short of collateral in general, then probably the added value we can bring is not as big. But the biggest problem is institutions, global institutions operating in over 100 countries normally have all of the collateral somewhere, but it's stuck. With HQLX just mobilized and it can instantaneously move. So there's no settlement batch, there's no market requirements because the assets, remember, they don't leave. It's just the right on the assets which are traveling. And that's also a big cost advantage. And we see that the ALM team in the banks are managing it much more careful these days and trying to optimize their collateral versus 5-10 years back.
Right. So they really capture the benefits by being able to mobilize collateral irrespective of where it is.
Correct. Because if you haven't got enough in your long box, then you need to finance and find collateral elsewhere. and it can be quite costly. But if you have it, you can't mobilize it, but still you need to go out and buy additional collateral in a market. This is where the big saving would come in. And also that we would add assets which are today not in the TPA environment. It's what we call internally as hard to fund assets. We bring new assets into this environment because also custodians can join. It doesn't need the full functionality of a TPA, which then enables that the pie of collateral which is available and which can be mobilized will also be bigger.
I understand. Now, Nick, I was interested to read in your documents that you're moving collateral intraday at what you term at precise moments. And that did surprise me, something I didn't expect. And if I've understood it correctly, this is an intraday collateral management product. So A, have I understood that correctly? And B, what's actually, if that is what's happening, what's driving it? How big is that demand for intraday collateral management?
Yes, I mean what the solution gives you is the ability to change ownership at precise moments in time, which can be intraday, or it could be on a term basis, i.e. over many days. So it really helps with both. But we're certainly seeing increased demand from clients to enable them to use their collateral in the most efficient way possible throughout the 24-hour day. One of the observations I'd make about this is that, broadly speaking, for an institution to optimize collateral, they need to know what they've got, and then B, they need to know how they can deploy it in the most efficient way possible. And then once you've got those two things in place, then you need to optimize. And really what HQLX is giving institutions is the ability to deploy it in a more efficient and flexible way than was achievable before. So that's how we are contributing to institutions' ability to manage their collateral more efficiently.
And are you supplying the collateral optimization tools, or are they using their own and you're just supplying the machinery, as it were?
Yeah, that's a great question. At the moment, we're supplying. I guess we call it the execution capability rather than the machinery. Mm-hmm. At the moment, we're focused on that, but it is certainly, an interesting avenue for the future to see how we could develop, optimization capability on behalf of clients as well.
Now, Nick, there's something else I'd like to understand, this term atomic delivery versus delivery DVD. Am I right to think that we're talking here of collateral baskets, and the advantage of this is that you do not have to deliver that basket free of payment, which obviously creates credit risk, or indeed delivered against payment, which creates liquidity problems. If I have understood that correctly, and tell me if I'm wrong, secondly, it's a kind of swap technique, really, and to my way of thinking, could be extended way beyond collateral upgrade trades as well. Am I right to think it's capable of infinite extension?
Yes, I mean, I think that, so DVD, delivery versus delivery, which is another way of saying atomically or another way of saying simultaneously, is really a play on DVP, which has been a long established mechanism for delivering securities versus payment versus cash. What we think we're delivering that's new here is the ability to do DVD across these disparate collateral pools, as discussed earlier. But you're absolutely right that the logical extension for the platform is to extend the DVD to include DVP, such that the ability to do that ownership exchange at precise moments in time and when you want is achievable for DVP, where the P is some form of representation of cash. And so that is something that we have on our roadmap, and is something that we're focused on as we speak. The other extension to this is actually the ability to pledge baskets of securities. So not actually versus cash, but for example, if you give me a basket of securities, I could then take that and use it to pledge to a central counterpart, or indeed, another counterparty to satisfy, an OTC derivatives exposure that I might have with them. So there's certainly a number of different ways of extending the original product.
And if you
maybe Dominic, if I just can add to the upgrade downgrades of the free of payment or DVDs, which are normally 2 legs, and that always consumes today either intraday liquidity or you need credit consumption of your credit line. With a DVD, both are disappearing, and you have got a big saving on your credit line or on your intraday liquidity, depending on the FOP or DVP. So for an upgrade downgrade, a DVD is really the magic solution to not to consume intraday liquidity or credit line with your custodian.
Right. And now, Nick, you mentioned that you might move from DVD to add a DVP component. And you indicated that might involve payment tokens at this stage. But looking ahead somewhat, would central bank digital currencies issued directly onto blockchain, therefore available to do the cash leg of DVP, would that be very helpful to you, or quite helpful, or just not relevant?
No, I think it would be very helpful. Certainly, what's sometimes called wholesale CBDC would be very helpful, to us and our clients. We're focused on Europe. We're focused on, therefore, on European currencies. You're absolutely right. CBDC would be helpful, but we're realistic about when that will become available. And so, whilst we keep an eye on CBDC, we're also focused on more immediate ways of achieving DVP for our clients. In other words, the ability to exchange, baskets of securities versus cash at precise moments in time and when you want. So it's a big topic actually, CBDCs, and we're certainly excited about it. But we're also focusing on immediate plans to deliver what our clients want as well.
And are you looking at stable coins in the short term? One of your shareholders has an interesting one.
We've done some analysis on all of the different options, and it's kind of a big topic in its own right. And we've looked at all of them, and we continue to have a dialogue with our clients on which ones are the best ones to move forward with in the short term.
Maybe just to add and give you a look behind the scenes, right? We have got in the community so many big players as investors, but also the banks represented in the user groups we hold. And the list of ideas how to extend it is kind of endless. We have got not a problem of trying to be innovative and what's next. It's more to get the existing solution with upgrade, downgrade, and single pledges for agency lending up and running on a massive scale and really demonstrate to the market the value we are creating. But the players on and around the table have endless ideas and how to extend it, either in depth or in breadth. So asset classes, regions, or use cases, plenty of them.
Yeah, I would that's absolutely right, Tom. And it's really not HQLX, coming up with these ideas in a vacuum. We work with clients and actually quite often, clients approach us with ideas and we help them, work them through. But there's a lot of possibilities here, and we're certainly very excited about the future.
I think it's a real demonstration from the start to make it a customer-oriented solution, not trying to be more clever than the market, developing something and surprise everyone. It was from the beginning, actually, a market-led initiative with the so-called Bravo banks, 10 banks around the table saying, yes, that's a good idea. Let's brainstorm how we can bring it to market. And that continued throughout the last 2 years.
Of course, ideas are easy, implementation is hard, as
Indeed
was saying. And Nick Tillman also said that the short-term goal is obviously to get this collateral mobility covering upgrade trades, up and running and working properly and delivering benefits. But can I press you a little bit about whether you've got plans to expand into other activities? Tillman mentioned, for example, you're taking a basket of collateral that could then be used to meet a margin call or cover a short position. Is that the type of thing you're looking to to cover other activities which do generate these needs for collateral, and short selling margin calls are obviously two very, very clear examples. Is that part of the medium term roadmap?
Yeah, I mean, I think that on short selling, that's not something that we're seeing a huge demand for from our clients with respect to our solution. But as mentioned earlier, certainly pledging to satisfy margin requirements is one, because it's just a very attractive proposition. So, for example, if Tillman has a basket of securities in a location that that I need to pledge from, then I can execute a collateral swap transaction with Tillman, and then I own a basket of securities in that, if you like, away location, and then I can use that to pledge it to satisfy my margin requirements from that location. So, and all of that, that whole transaction, first the collateral swap and then the subsequent margin pledge happens without the securities physically moving, to Tillman's earlier point, and that's a big advantage. And we see a lot of interest from our clients in building out that kind of flow.
I think the big theme in the industry is the mobilization, and to mobilize it, that's already a big challenge which is out there for many years, and which is now addressed. Then optimize it, but then to reuse it, like Nick said, that you have got the collateral and it's still mobilized and can be reused for a UMR or whatever. This is the big topics we are working on, is the reuse as much as possible, because that gives a second life to the asset.
Mm-hmm. Now, Tillman, you've been pretty clear. You want to learn to walk before you can run, but and I'm sorry to be so annoying about looking too far into the future, but is there actually any limit to the idea or the application of the idea of these frictionless ownership transfers of assets? Is there any limit to it at all?
I would say no, not from the concept, but coming back to, we are servicing the financial markets and financial institutions, so that's why we are staying with the existing asset class, and obviously under strict regulation, and we always need the smallest common denominator. So if one jurisdiction is relaxed but the other is not, it doesn't help us too much, because the customers are normally acting global. So we would be very strict on being kind of regulatory compliant for mass market, where professional financial institutions can see a benefit, and we are focusing on that niche. That niche is big enough, that niche for the moment.
Yeah, well, the niches come in different sizes for sure.
Yeah, exactly. It's a niche of 3.6 trillion.
Yeah. Now, back to making the business grow. Nick, network effects are obviously going to be hugely important to this. You touched on who's in the queue to get fully involved right at the beginning of this discussion. But can you tell us a bit more about what progress you've made in attracting users from the supply side? And I'm talking here really of custodian banks as agent lenders. You've touched on this a number of times, that it's open to all comers. And on the demand side, you've also got Goldman involved already, but all the other investment banks would clearly be a source of demand as well. So network effects, how quickly can you grow this network? What are the techniques you're using to grow the network?
Yeah, good question. I mean, it's true that the platform was originally conceived as a bank to bank demand side solution, and that's pretty well established, and our clients are focused on the benefits that they'll get from that. But it's also increasingly the case that we're turning our attention to the supply side too, and in fact this year, we'll be connecting Bank of New York Mellon Agency Sec Lending and JP Morgan Agency Sec Lending businesses to the platform as well. And so what this gives us is just, well, obviously more supply of collateral on the platform, and it also gives the borrowers of that collateral the ability to use the platform for the benefits that we mentioned earlier, all of the upgrade, downgrade, capital cost saving benefits that we discussed. So we're very excited about this product development. I think that we we certainly do use the network effect. We have, as we mentioned earlier, a strong shareholder base who have helped us and are helping us market the platform and promote the platform. So we're very excited about the future and certainly leverage their network effect expertise as well.
I think maybe to add, at the beginning we started off with the banks. The banks pulled us the supply, so all of the custodians and TPAs, which then again now are promoting it, saying we are part of the game. And as you can see with the press releases out, and then this adds liquidity and credibility to the system. And then the customers, more and more customers come and approach us on the participant side saying, now we want to join, our custodian or TPA is already part of it, or even it's missing, can you please connect them as well? So it's kind of push and pull where one side helps the other side, and in the middle, we have got a long list of participants we need to onboard on request. We can always talk just on the names which have given us the permission, but the team on HQLX and the TTP is busy onboarding quite a substantial number of participants at the moment.
So Nick, just to be clear on this point, how many are live? How many users are live on the service now? Who are they? And as Tilman has just said, there's people queuing up to do this. How long's the queue?
How long's the queue? The queue is quite long. I think really the question is, when do those people on the queue, join the platform? I mean, by the end of this year, we'll have the likes of, Commerzbank, Credit Suisse, UBS, Goldman Sachs, Bank of New York, Agency Sec Lending, and JP Morgan Agency Sec Lending, on the platform. Some of those institutions have already executed trades already. And then, as Tilman said, we have a longer list actually, behind those leading banks, all of whom are, in various stages of onboarding to the platform. And of course, as Tilman said, these institutions talk to each other, and they encourage each other to onboard and execute trades on the platform. And of course, they in turn encourage others to get started with the onboarding process. So, we're certainly, that's what we mean by the network effect, and we certainly see that happening, and we're excited about how that attracts participants to the platform.
And just to add, Nick, on the TPA side, we have got the BP2S, BNY, Citi, JP Morgan, all live, and now promoting it equally. They will be all live, fully live, end of year, and each and everyone is promoting it now to their customer base, obviously saying we are ready, which is basically this push and pull effect, which is quite nice.
Right. Yep. Now, obviously, the people who are live and the people in the queue have kind of made a commitment to do this. But as you talk to firms around the marketplace, around the world, what are the obstacles you're encountering to why they wouldn't join? Is it because they have to spend money on interface? Is it because their processes are so archaic they can't accommodate the way you're doing things? Is it because their own technology is out of date? What are the obstacles to actually joining HQLAX, and how can you overcome those obstacles?
Yeah, look, that's a great question, and I think frankly, you list some of those obstacles in your question, and I'm not going to deny that they exist. And I would say that it's not a uniform. They don't exist in exactly the same way across each institution, and it's actually been interesting to observe the variation in across institutions. But what I would say is that, with any new innovative product, it's often not that easy to change the way that things are done. And actually in this particular marketplace, securities lending marketplace, change the way that things have been done, I think for many years, I think it's fair to say, in the same way. So there's certainly new challenges of rolling out a new innovative product. But I think it was Einstein who once said that we can't solve problems by using the same kind of thinking that we used when we created them. So it's certainly, it does feel like that this marketplace is something that, is, if I can say, ripe for a little bit of innovation. And I think that's what we're trying to provide. And of course, there will be incumbents who will, to a certain extent, resist that change. But I think that, we are making good progress on moving things forward. And I think that in addition to that, there's been a lot of focus on from institutions in recent years on regulatory changes. And I think that there's certainly a little bit of a sense that perhaps going forwards, there's a little bit more capacity to take on new ideas such as HQLAX.
Mm-hmm.
Maybe just to give it a different spin. Sorry, because Nick has in the background a nice picture on the marketplace, whereas the digital platform, the TTP and the TPA. Why we try to make it as easy as possible for the customer, because if the customer has today Eurex as a trading platform and they've got a collateral location, there is, in inverted commas, not a lot to do because they've got all of the legacy technology already in-house. But what Nick said is completely true. This new product procedure in an organization in the vertical, from mainly a legal perspective, to ensure that nothing can go wrong in this new setup in between, this is where all the banks go through intensive reviews, risk management, legal, to ensure that the front-to-end process is working in a regulatory compliant, safe, and resilient way. And that's what takes most of the time. The connectivity on, if you're Eurex, you're trading today, nothing to do. You have got your TPA, which you can put all of your assets in future, use it as a long box and deliver out everything to the other TPAs instantaneously, is a great thing.
I was just thinking that, as Nick said, people are switching away from investing in regulation to investing in things that might make the business more efficient. I guess one of your benefits you can offer is that this helps them comply with regulation, particularly on the capital side. But anyway,
yeah, that's true. Sorry, yeah, absolutely true.
Always a free marketing argument from Future Finance.
Thank you very much.
Now you mentioned that your existing users are in effect marketing the service for you by talking to their counterparts to get involved. What other strategies are you using to, obviously you're bringing people up yourself and going to see them directly yourself. What other strategies are there for distributing this service apart from using existing users to persuade their counterparts and direct approaches from yourselves?
Yeah, I mean, I think we've talked about some of these. I mean, we have investors, we have participants, and as Tilman rightly said, we have custodians and tri-party agents connected to the platform. So we have a pretty healthy network effect across all of those. HQLAX was founded by two people that have had some time in the marketplace themselves, and so they've got good network connectivity. We're effectively orchestrating a market infrastructure. So as Tilman said earlier, one side pulls in the other side, and we're certainly seeing that. It's stating the obvious really, but it takes two to do a trade, and so you need, if one side is interested in HQLAX, and you need, they'll encourage others to join the platform to do that trade. So it's really a mixture of all of those, and then of course on top of that, it's the usual, marketing routes, go and see people, social media, etc.
Mm-hmm. Now, interoperability. One of the benefits of your platform, Tilman was very articulate about this earlier on, is actually you get away from interoperability problems in collateral management. But clearly, it's being able to interoperate with other networks, by which I mean both traditional networks as well as blockchain ones which exist already, which may exist in the future, particularly as you expand the range of asset classes and collateral demand techniques which you cover. Do you think that interoperability depends upon some kind of agreement on data standards, or dare I say it, even message standards? Do you need something to to make the connectivity more seamless?
Yes, I mean, I think that's the short answer is yes. Although you can do it without that, but it's certainly something that we're very focused on. We think that across networks that there is an opportunity to collaborate, and we're certainly open and actually actively collaborating in a number of areas. We are also fans and supportive of the ISLA CDM, so the common domain model, and we've had some discussions with them. So yes, I think that one of the implications of an HQLX model is standardization, but that's something that we're focused on as part of the vision. But again, we're taking baby steps towards that.
Mm-hmm. And is it very complicated by these legal obstacles you've referred to, different jurisdictions and so on?
I wouldn't say it's very complicated. It's just something that we maintain focus on as we evolve the platform going forwards. But it's just one of those things that obviously needs to be done.
And maybe just on that one, because the marketplace, let's say, is orchestrated in Germany, the collateral location might be in Belgium or Luxembourg, the TTP is in Luxembourg, the customer is in the UK. So it's the integrated silo to make sure that a UK customer operating on these various jurisdictions, the TTP being in Luxembourg, that everyone feels comfortable and it's regulatory compliant to the bank regulation in the UK in that example. And that's where it gets complex, because all of the various combinations needs to work. If one combination doesn't work, the entire thing doesn't work for that customer. And that's why it is a European thing. And we had to register the TTP in Luxembourg. We've got so much to do to make sure it fulfills all of the regulatory requirement in all of the European countries to start with.
So, Tilman, if it's complex within the European Union, presumably as you expand this service to other geographies, it's going to get still more complicated. This problem isn't going to go away. It's going to get more extended, isn't it?
Yes, to a certain extent. At the moment, we want to focus on Europe, on the marketplace Europe, but of course the assets can be outside. But then we need a legal opinion. Can we mobilize them? How they are recognized? That's why we said let's start and focus on making the European marketplace more efficient. But then we have got already plans how to expand and where first, in which other jurisdictions. Yes.
So there's no concrete plan at this point, Nick, to, I don't know, go to Asia.
No, there's no concrete plan. I mean, we're focused on Europe. We're focused on getting the platform established in Europe. But there is absolutely demand for Asia and the North Americas, including Canada, for example. So there's definitely the demand. But as Tilman said earlier, there's a lot of things that we could be doing. And so we are very focused on remaining focused on our short-term deliverables. Sorry for the double use of the word, but that's certainly our objective, to stay focused on Europe and get the platform established there first.
I like that area of focused on.
Yes.
But talking back to Europe. If we look back 20 or 30 years, Europe seems to engage in this very extended process at various levels to create a more efficient post-trade environment. And we've had Giovannini reports and we've had T2S. We have a European collateral management system run by the ECB and so on. But we still, national markets still seem very, very closed. The actual volume of business which is being transacted by national systems across national borders is still very low. There's a European Commission report about this this week pointing this out. So does the value of your service to some extent depend upon the persistence of these siloed securities holding and settlement systems in Europe?
Yeah, that's a great question. I mean, I think we see HQLX as, or the operating model of HQLX as being the natural evolution of that existing model. DLT or distributed ledger technology has certainly arrived at the right time to help, frankly, to help reduce the impact of that siloed model that you refer to. I think it's, like anything, it's evolving, but certainly we think that we're complementing that existing model today.
And I think it's a difference between where the local investors invest in and where the settlement takes place and all of that, and how financial institutions, professional institutions, need to manage their collateral. And I think there it's definitely international, and we are the enabler between the old and the new world. So we have got a solution, but you are right, obviously, in the silos still exist, and they will probably exist, and they might exist for the next 20 years. But for our segment, so collateral management optimization for professional institutions, I think we have got a great solution.
Mm-hmm. Now, Nick, you mentioned DLT technology come along at the right time. You mentioned earlier using R3 Corda, which of course the blockchain DLT purists would say isn't really a blockchain at all, but it does, I assume, allow you to overcome the problems of speed and scalability, which classic blockchain would present to you. But is there any loss of benefit you get from that? You see what you gain, but do you lose something?
Well, I think what you're referencing in your question is really a difference between public blockchains and private permissioned blockchains. And we certainly took the view back in the day that we needed a private permissioned blockchain because the transaction that I enter into with Tillman should be private and only visible to Tillman and myself. And so that is one of the key differences, and it's also one of the differences why we chose R3's Corda DLT in the first place, because it was originally crafted and designed to specifically satisfy the needs of capital markets, and therefore ensure that only those two institutions that have actually entered into a transaction can see the details. So that's why we went down that route.
Mm-hmm. Perhaps my question was, Nick, needlessly obscure. You're right. I was thinking of that, but I wondered if being private permissioned rather than public non-permissioned makes the network effects more difficult rather than easier.
In what way? Sorry.
Well, if you were a completely open network, anybody could join this. With a private permission network, you will have some control. Your existing members won't. There'll be certain people they might not want to be part of the network because they don't trust them for some reason. On the one hand, that could make your life easier because it enables you to control who's in this thing. On the other hand, might make it more difficult because you'll come across people you'd love to have as part of the network because they could contribute a lot of assets or contribute a lot of demand for assets, but they don't fit in. That's what I was wondering.
Well, the platform is really focused on securities lending participants, who are highly regulated. So there is a certain, closed nature in terms of who can participate on the platform. So yes, you're right. That's another reason why we're not using a public blockchain, and therefore that it's open to everyone under the sun, as it were.
Yeah, I think that's important. It's not for HQLX or for Deutsche Börse to judge, but it's the customer demand. The customer wants to know who's in the club, who are they dealing with, what's the risk profile, etc. And they would be highly scared if it would be open to everyone on a public blockchain. I think we wouldn't have pulled it off if we wouldn't have gone with that concept.
Yeah, and I guess you have a very well-defined universe as well. I remember somebody once saying to me that only 70 people on the planet are actually even interested in securities lending and financing. So a nice, tightly defined group of institutions and people.
If it's 70, then probably all of them are in the list, yeah.
Now, one other thing is you allude to HQLX being able to deliver regulatory transparency. I wasn't quite sure what you meant by that. Was that a reference to SFTR reporting or something else?
Yeah, it could be, but really the point of this is that with this type of technology and this type of solution, you have the capability to provide a regulator with a node, and so all within the, the permissioned rights, etc. But what that would give a regulator is a view of the transactions that they should see, which is by definition consistent with the view that the participants have with respect to the transactions that they've entered into. So the point is that there's no need, therefore, for separate feeds of regulatory reporting from each of the participants, and then you kind of have to hope that the two views of trades match up somehow. They would already be matched up from the get-go, and then that's frankly, one of the broader benefits of this type of technology and this type of solution is that it has a consistent view of the data up front rather than needing to reconcile, thereafter. So that was really the point of.
Yeah, I think the TTP is the regulated entity which provides this transparency, and there's just one rule book which defines exactly who's the owner, what happens, how's the process, and the regulator can look at that rule book and look at the TTP and the engine and approve it or not. And then it's not bilaterally agreed, and everything is bespoke. It's one rule book which would be which we got approved by the regulations or regulator in the various countries, and which is the masterpiece, right? So that's the magic document which provides all of the mechanics, and the regulator is open to have a look at one central rule book.
Mm-hmm. Yeah, it's about regulatory reporting efficiency and no need for reconciliation and so on. Yeah, I can see the benefits of that. Now, Tilman, one of the great debates I notice in many of the discussions we have with organizations trying to change the way things are done in a marketplace, and obviously at either extreme, there are people who want to do nothing, and at the other extreme, there are people, well, I wouldn't do it that way. We should just totally reinvent this market and not pay attention to anybody. But I do notice that a coming together in the middle, a more pragmatic approach by people where they're looking, a lot of fintechs are looking to get regulated, and a lot of regulated firms are looking to see what they can learn from what fintechs are doing, and you kind of fall into that that pragmatic, evolving approach to it. But one of the points of difference which has emerged in these conversations is the difference between relying purely on competition and commercial incentives to drive change, but also the need to be collaborative. Now, I think I'm right to say that this entire project HQLAX began as a proof of concept, if you like, within the Deutsche Börse group, and it has broadened out and become a collaborative project. You decided not to go down this purely commercial competitive path. So what explains that? Why was it necessary to be collaborative rather than commercial competitive?
I think it's both. We from Deutsche Börse and HQLAX always had in mind that we need to open it up. So we never wanted to own it 80%, 90% and leave it as a closed club. That was clear from the beginning. It only works in a collaborative approach. But we very soon, when we talked to the market participants, we got a request to from the customers connecting. They wanted to invest as well and be part of this new ecosystem, and that was then in end of last year, beginning of this year, the right timing to do that. But if we would have gone with the proof of concept and wouldn't have done the initial funding back 3 years and would have just gone with the concept to all of the players, it would probably not have worked at that time. So we provided the initial funding, always having in mind that at one moment in time, if it flies, we need to open it up because we need to collaborate. Building it on your own is probably not going to work.
Nick, to further elaborate on that point, in a sense, can we just, this is my last question, can we talk about the money? You've this year completed a Series B funding. And as we've discussed, you've got BNY Mellon, Goldman Sachs, BNP Paribas, Citi, Deutsche Börse, obviously there, and just very recently, JP Morgan has joined the group. You've raised nearly $30 million. Was it dollars or euros? Doesn't matter. But does this ownership group actually limit in some way what you can do? And as you look to expand the product set and the services you supply to other asset classes and other types of transaction, are you going to be obliged, in a sense, to open the ownership ledger still further? And what's the attraction for people coming in as shareholders? They obviously benefit from the operational capital, liquidity savings, and so on. But is there going to be a dividend they're going to get from this as well? So, if you look forward 5 or 10 years, how do you envisage the future of HQLAX in terms of how wide will the shareholdings be, and what sort of business model will you be operating to? Will these shareholders be collecting rebates or dividends? Maybe it's too early to answer this question, but I'm interested to see how you see the organization evolving commercially, financially, and in terms of ownership structure.
Yeah, sure. I mean, I think what I would say is that, as Tilman said, this has been a collaborative process, and we're super excited to have on board all of the investors that you just listed, and of course, with Deutsche Börse as well. In most cases, this is I think it's fair to say this is a mutually beneficial arrangement, because these investors want to see the platform be a success. It's not the most exciting word, but this is a piece of market infrastructure, and they will all benefit from using it, either as participants or as tri-party agents or custodians. So that is why it's not really just about the money; it's also about the contribution to the overall platform success that these investors will bring. Where we are right now is that we frankly have got all of the strategic investors we want at this point. So we're not at this moment in time planning to have any more, but anything's possible in the future. But we certainly feel good about where we are, and we're super excited about what each of these investors will bring as a whole and both individually to move the platform forward. So, going back to the start of your question, we don't think this limits anything particularly. In fact, we just think it's all positive, and it's really it will just help the platform be a success in the end.
I think when we put together the list to our various boards on who we want as a strategic investor, not looking at the money, but looking at who can make the success of this platform more likely, we probably got the who is who and everyone we had on our wish list. Now, going forward, one statement would be, we are not closed. We would listen to everyone who wants to get in. At the moment, there's no concrete plan, but there are two different interests. Let's say for the treasury or the ALM management of a bank, they just want it to work. They want their cost saving, and they want it as cheap as possible in our solution. They don't want to be shareholder and then comes all of the others who are arrangers, agent lenders, etc., where we don't think they are too much interested, because they might get conflicted with MiFID inducements if they route it that way and also get a dividend. So I think at the moment we have got the right shareholder structure. We've got the right people connected already, and the critical mass. And basically, I can't think of more than one name who's not connected yet on the TPA level, which we are working on to complete the offering. And we've got a long list on the participants, and none of them are really now asking and trying to get into the shareholder structure. They want to make it work, get their savings they've promised. If they use HQLX, they're going to generate for the asset liability management of a bank.
Tilman Fichter and Nick Short, thank you very much for taking so much time to explain so clearly, so openly, and in such detail what it is you're doing at HQLX. Thank you.